Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for August 2025, proudly brought to you by Ainslie Wealth. My name's Chris, and today we have back our expert panel who have joined us to go through this journey for a number of weeks. We've got Joe and Isaac. How are you both going today?
Quite good, actually. And we're entering that part of the cycle now where it is very important that we keep track of everything very diligently. And I think we're actually very, very prepared, as we've been this whole entire time going through. But I think it's going to get very exciting from here on out.
Joe, we do tend to have more of these conversations before we get to this monthly one. We seem to be back and forward about it all the time at this stage of the market. Is that what you're feeling?
Yeah, as we've been discussing as well, we're just sort of looking for that trigger point that would cause the market to have a sort of longer term reversal to the downside. But as we go through, we're probably not quite seeing any real reason yet, and we're still we're still fairly early in the cycle, we believe, but that doesn't mean we're necessarily immune to any corrections. But yeah, we'll have a chat about it today. It'd be great.
Oh, excellent. Looking forward to digging into a lot of it today. But just before we begin, a reminder to everyone that everything that's said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, situation, or objectives, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Now, the agenda will be the same as it usually is. We do the macro big picture stuff first, then we'll have a look at the Bitcoin market and then some Bitcoin technical analysis. Joe, you mentioned just then that we're starting to look at, well, when we look at this, we wonder, are we late in the cycle? But really, a lot of our data is still suggesting that we're best case mid-cycle, but still a lot of data showing early cycle. That's confusing for a lot of people because I think when you see what we've been seeing this last week, the Bitcoin back up near all-time highs, how is that still early? How do people think about that?
Yeah, so I suppose we're looking at the Bitcoin cycle as part of the liquidity cycle and the business cycle, right? So on the liquidity front, we're not seeing a huge amount of liquidity injections. As you can see, it's very stop-start from the bottom of the cycle back in September 2022. And then from the business cycle as well, we haven't seen a lot of growth or inflation, which would cause us to think that we're not near towards the end or late cycle, which is generally where you get the final blow off top. And at the end of the day, I don't really see the government or central banks wanting to put an end to this cycle just yet. When you've got growth and inflation, so sort of towards the lower end, like this is not really a need to be killing this bull market yet.
Well, let's have a look at that. And I want to dig into both of those aspects because we've been discussing it quite a bit recently. First of all, growth, and this is using the US growth, but it's a pretty good proxy for growth everywhere, really. You've got the line, the dotted line in the middle there at 50, and above that indicates growth, below that indicates contraction. Now, we've been we haven't been rocketing off with solid growth for quite a while. We've had a few goes at it. It feels like the economy really wanted to take off, but it just never got there. And now, really, I mean, the services one is sitting slightly above the line, but the manufacturing's pretty well below the line there. And your leading indicators sort of hovering, but still below the line. We were talking about that, suggesting that bad news in this particular case, from the growth perspective, is actually good news for assets like Bitcoin. Now, that's a big call, and it's something that needs a little bit of unpacking. So can you talk us through why we've been sort of suggesting that this is almost a Goldilocks zone of where you want growth to be, not so good?
Yeah, well, it goes back to what I was saying about governments and central banks not wanting to kill the business cycle yet, because we haven't really had the up part of the business cycle yet. So if for example they were to withdraw liquidity and go into austerity measures and continue reducing the balance sheet at a rapid pace, like the central bank balance sheet, then you're going from an economy that's reasonably weak to an economy that's very, very weak, which in the end would be a cause for more fiscal stimulus, right? And it would actually blow the deficits out more, as we've spoken about in previous episodes, because if you destroy asset prices, then a large part of that revenue that goes into the government general account dries up, and then the deficit blows out further. So I just cannot see how they'd want to put an end to this bull market just yet.
And when you say they want to put an end to it, is it as simple as that? Is it really a decision that's made to kill the bull market, or does it just come to a natural end? Because you've mentioned this before, this concept that they don't want to, like, who's the they in this situation, and how can you be so confident on that?
Yeah, so they are, when I say they, I mean like the Treasury, governments, and central banks, right? So I think if we look back to 2020, early 2022, when inflation was quite high, a lot of people sort of believed, oh, well, we need to raise rates to squash inflation, but sort of no one really believed them. But at the end of the day, like in hindsight, you look back and go, they were telling you basically to your face that they were going to withdraw liquidity from the markets and asset prices were going to fall. And that's also why in February and March, when we were talking about those austerity measures from the Trump administration, we were quite cautious, because at the end of the day, like if you go into austerity measures, there's less money flowing in the economy, which is not terribly good for asset prices. They've obviously reversed course since then, but and we've seen the repercussions in the Nasdaq and Bitcoin and gold.
And I think you've hit the nail on the head when we talk about the big driver. If you look at this chart, which is the inflation chart in the US, they never want to kill the bull market, obviously, right? Like they want to keep a bull market going forever. I think you highlighted there that they're sort of forced to kill it eventually when inflation gets out of control. If you look at the leading indicator here, which is sort of that trueflation data, it's pointing down below that 2%. The lagging indicator of the actual inflation rate is a bit above. I've seen posts on X from Trueflation themselves saying, look, the Fed really does need to cut here because the data is just not correct. The real-time, the lagging official data, the real-time data, inflation just isn't a problem here. So does that add further to your argument that bad news is good news here, because they will keep stimulating, they will keep spending money to keep the economy going, because the one thing that would stop them would be high inflation, and that's not here.
Yeah, absolutely. And you talk about that lagging data. Well, we get the CPI and we get the jobs data every month, and you look specifically at the jobs data. There was a massive revision to the downside last I think it might have been last week or the week before, and Fed rate cuts jumped from, I think it was about 10-15% to 90% today, just because a lot of this stuff is backward looking. We've actually been saying this for a while, that inflation is somewhat subdued. Now, that's not to say that it's not going to tick up during the business cycle, but at this point in time, it's looking like the Fed will cut rate at least a couple of times this year, and that's potentially very bullish when we look at our liquidity and our macro framework in terms of business cycle, because they could end up cutting rates into a growing economy, which would be huge for asset. Yeah.
Is that just throwing fuel on the fire? Like that makes
absolutely,
yeah,
absolutely.
So you could see that scenario. I agree with you. You could see that unfold. You mentioned the liquidity cycle. We talk about this. This is the core of everything we do, really. If you zoom out, I've arranged this slightly differently this month, but if you zoom right out and look at it, we can say, okay, very consistently you get these boom and bust cycles that are driven primarily by global liquidity, which is the mechanism of which you just sort of went into a little bit there, Joe. But when you look at the latest data that we have for last month, we sort of just ticked above that 50 line again, which the 50 line in this index term means that we've got the rate of change expanding. Excuse me. Looking at it in another way, on this chart, we can see, yes, it's expanding probably at about a 7% rate at the moment. Bitcoin, we look at Bitcoin through this lens because ultimately liquidity is what separates assets that keep going up versus the CPI inflation. Now, there was a few things I just covered there. Joe, I want you to bring this together. I stopped on this chart deliberately to highlight why the CPI inflation and the monetary inflation are not, or the asset price inflation at least, are not the same thing, and why that's really important, particularly at the juncture we're in at the moment, and also why that leads us to looking closely at Bitcoin.
Yeah, so I've actually, when we get to my chart deck that I brought along, there's a couple of charts that really emphasize the importance of that sort of capital over labor, which is effectively what you're seeing here, right? So you can see that asset prices and liquidity grow a lot faster than what the CPI measure is. And if you think about people's wages are generally tied to CPI, right? Like you might get a 2 or a 2.5% pay increase each year. Whereas when you look at liquidity, as you mentioned before, currently growing at 7%, okay, well, that's highly correlated to assets growing at 7%, and we're not even really at the end of the cycle yet. So we could see 12, 14, 16% asset inflation, whereas your job, you might be getting a 2 or 3% pay increase, which is also taxed, by the way. Whereas when you invest in Bitcoin, gold, and whatever, that's tax deferred assets. So you get the compounding of holding those assets over the long time. So it just really goes to show that you really just cannot keep up with a wage-based income versus holding scarce, desirable assets.
Yeah, that point is so important that people really do need to understand that. I will come to that conversation a little bit more later, because we've been having some interesting conversations in the background around decisions that people should make, particularly younger people, all these sorts of things, how it fits into this backdrop. If you continue from what we were just discussing there and what's on that chart to look at this chart, which we brought up for a few months, it's highlighting the sensitivity of certain assets to global liquidity specifically. And when we're talking about a 7% liquidity boost, that's sort of the rate of change at the moment, this would be implying we could be seeing as high as a 70% gain in Bitcoin over that sort of 12-month period. That's quite interesting, because you've made this point before about it, you want to be in the fastest horse in the race. I want to take this slightly differently this month to say, yes, we look at Bitcoin through this lens, but a lot of people will want to go further out on the risk curve and look at alts, for example. What do you say to them in the context of that rate of change we're seeing, that 7%-ish rate of change at the moment of global liquidity, the multiplier, which could be effectively 10 times, we're seeing a 70% gain in Bitcoin currently, and the alternative of going into some of those alts, which could make a much larger return if you select it correctly?
Yeah, I guess it just comes down to, like, everyone's situation's a little bit different, right? So if you're starting with a very low capital base, I can see the appeal of wanting to go out on the risk curve. My experience and what I've seen in the past is that a lot of people have made a lot of money in these alts or less lower market cap coins, but actually haven't held on to the gains because they don't believe in the project long term, or they believe it's going to keep going. So, and we've made that mistake. Friends and family have made that mistake. Whereas when I look at Bitcoin, for example, if you can get, over the last 5 years, Bitcoin's returned a compound annual growth rate of 60%, right? So we can obviously expect that to come down. So, but if you're playing, and we'll talk about this later as well, if you're playing the long game, maybe you've got a 10, 12, 15-year plan, you only need 25, 30% compound annual growth with some dollar cost averaging in, and then you're pretty much set for life. So I think the difference there is like your time preference. And I understand people want it straight away, but sometimes that's not necessarily the best way to play it.
It's such an interesting thought process, because we have this conversation. I know you and I have this conversation all the time with different people who really want to get there faster. And we keep coming back to this idea of, yeah, but you've got sort of the certainty, as much as you can be certain in any of these markets, of a higher return by sticking to something simple. Making it more complicated doesn't necessarily mean a higher return, because you can't necessarily hold it for the entire time. You end up, picking the wrong one. You're off by a little bit. There's a million excuses that people make.
Yeah, there's just too many factors, especially for the altcoins, and especially if you're just starting this space. If you're not experienced, it's literally just like throwing a dart at a board and expecting it to hit. So it's not even worth it, to be honest.
And we're not like, it's different to 2017. Like, if you looked at CoinMarketCap in 2017, there was basically, I don't know, 100 coins you could invest in, right? So as Bitcoin went up and capital flowed out of Bitcoin into those more speculative assets like Ethereum, XRP, and a few Litecoin and all that, at the time, there was very limited area or coins where the coins could actually flow. Whereas now there's literally tens of thousands of coins where capital can flow into. So it makes your chances of picking the right one even slimmer.
Yeah, exactly. And especially with the advance of the meme coin space too, which is a pocket of liquidity that's sucking up stuff. So, but I see eventually all this flooding back into the most pristine asset, which is Bitcoin.
Yeah, absolutely.
Yeah,
I agree.
and it's worth having the conversation. I mean, we're not saying that. I think you framed it correctly, Joe. It's different for different people. We're not suggesting that it's only Bitcoin for everyone. I mean, we certainly feel that ourselves. We're very Bitcoin maxis, but when we can certainly understand the argument that others make about why alts are for them and why they want to be further out on that risk curve.
Yeah, it comes down, like you and I personally, it's about making money, not necessarily making the most amount of money. You know what I mean? So if you're holding Bitcoin, our belief is that you are going to do quite well. We don't necessarily mind if someone out picks something else on the risk curve and makes 10 times what we made, like in terms of percentage, like that's fine. So I understand that that's where a lot of people are coming from and that's what they see. But yeah, at the end of the day, I think investing is about playing a long game.
Really, well, and the next point I'll make on that is part of why we narrow our focus is because we need the data and we need good quality, reliable, consistent data to be able to make these decisions. And there just isn't consistent data on Fartcoin, right? Like you can't go and get the background and the years of research and the pure amount of human effort that's gone into thinking about this and the analysis and that as well. Looking at through that lens, this is our current, it's a week old, but I got the latest data just this morning before we recorded to suggest that liquidity has ticked up a little bit more again. We see the weekly raw sort of global liquidity number certainly heading up from where it was 12 months ago. And you look at the Bitcoin price overlaid on that, reflecting it quite well. You made the point, Joe, that we were still looking pretty solid in the liquidity space. We talked about numbers like 7%. If we look at the components that break this down, we're starting to see some solid green that we haven't seen for a little while, particularly coming out of the US. China seems to be on and off again. And, there's a bit of red there this week, but it was green the week before. It's all over the place. But do you see a sustained push of global liquidity still ahead of us from these major central banks?
So talking about where we are right now, like if you're looking specifically at the US, because that's sort of where we probably have the most edge and they're the most transparent with what they want to do. Q3 is going to be quite a large funding period for the US. So they're looking to raise 1.3 trillion into the TGA, right? So usually if you're raising that sort of cash, that cash comes out of the banking system, which is a negative drain on liquidity. What we're seeing is in August, the first week of August, well, last week was actually a huge refill of the TGA. I think they issued about $600 or $700 billion worth of bills, right? And the key word being bills. So there's a lot of demand for that short-term debt. And I'm just thinking at the moment, if markets are all-time high and we've got the TGA refilling in those sorts of numbers, and we're not seeing a significant liquidity drain because there is demand out for those bills, either through bank deposits or reverse repo money coming out and into the TGA. Once that TGA is full, we're going to have $700 or $800 trillion of cash sitting there, which is going to flow into the economy, which is very, very positive for financial markets.
So you could definitely see that green continuing. We could get a period like we did back in 2021, where we have solid green for a while.
Yeah, absolutely. So, historically, August and September are seasonally weak for asset prices. That doesn't mean we can't over the next 4 to 6 weeks. But I think, as we've been saying for a while, if we were to get that significant liquidity drain and asset prices were to fall, I'd once again see that as a buying opportunity for what we think would happen into the end of the year.
Now, we've got a new chart here, which actually combines a couple of things to do what everyone always wants, which is price targets. But it's looking at what would be considered fair value for global liquidity if you looked at it through purely fair value for Bitcoin price, if you looked at it purely through a global liquidity lens. And it would suggest it's sort of being shifted forward. It would suggest Bitcoin still has a little bit to go here before we reach the top. It doesn't go that far out. It only sort of goes out about 3 months. But it would be suggesting that a reasonable price for the next 3 months would be pushing closer to 140,000. Joe, I'll ask you first and then Isaac. Is that consistent with what you would imagine if you sort of, I know, Isaac, you'll have other factors to add into it, but does that price seem reasonable to you?
Yeah, and that we were talking about this yesterday as well. In terms of liquidity, I think that's a fairly reasonable price, and it's based on like technicals, which I think Isaac would probably back me up on this. That sort of 135 to 140 region is quite a significant area for where we think that there could be a reversal on the next run.
Isaac?
Yeah, I do agree. One thing I would like to note before we get to that, in this fair value model, you can see the deviations with the blue line going down and Bitcoin price, the deviations, it's actually holding up stronger, which is actually quite a good sign of strength considering that the fair value is suggesting it should have been lower. So that's just a little notice I've point out there, showing strength in the market and there's demand for it, even though the global liquidity was tracking down. In terms of a target, we'll get into that more in depth. But yeah, that does line up pretty well with what I'm sort of seeing too.
Yeah, and remember, we look at this through many lenses. This chart is specifically looking at it through global liquidity lens, which is interesting because we'll see if that does line up.
Yeah, and like from a long-term, more macro point of view, that's objectively the most important metric that we are looking at, to be honest.
Yeah. All right. Well, let's get into some of that Bitcoin market analysis. We've got, first of all, you often start here, Isaac, with the MV/RV/Z score. Lots of letters there, but the basic idea that you've told us month after month is that this is possibly not going to get as high as it has previously, but it could still get high. Well, you would still expect it to be higher than where it is now. How's it looking?
In terms of a nominal value, you might actually get pretty high, but in terms of the exaggerated move, it is looking to me like it will actually be a little bit less than what it historically has been. And that, to me, that makes sense with the institutional demand we've been seeing, and the more staircase price action, which I've gone over in many, many videos that we've done. And I think that pattern's going to keep playing out, although I do think towards the end of the cycle, when more media press starts talking about it, we're seeing more global liquidity coming to the system. All those metrics are pointing towards the more euphoric side, because I do think the higher we go, it will attract more people, as it always does. We might see that advance a little bit faster in terms of the steepness of that angle going up, which is the Z score, which is the orange line, which actually might hit us around the 4.5-ish region. So we'll have to see how it pans out, but it is looking like it is coiling up in terms of the Z score. And we saw that down the 2017 run. It sort of coiled up and then it had a spring right up towards the end there. So we might see a similar resemblance in patterns, but I wouldn't be expecting it to be shooting up like crazy, although it would be a nice surprise if it did.
And that's fairly consistent with a few analysts I've been listening to suggesting that some of our indicators are getting a little bit high, but there's still plenty of room for them to run.
Yes, that's correct.
Like that seems to be consistent across the board.
Yeah.
You've used this chart before as well, with effectively combining a few different metrics together.
Yeah.
What's this suggesting?
So it's a conglomerate chart. It's got about 7 main indicators that a lot of people in the space look at. You've got pi cycle, you've got EMA lines, you've got deviation scores, all that sort of stuff. Conglomerates an aggregate average score. So right now we're sitting at 77. And you can see the 3 little local peaks we've had this cycle. It's reached around that 80, 70 region. So typically when it does top, it reaches the 95 bracket. So we haven't seen that happen yet. But that being said, this cycle, if we maintain the way it's maintaining, it doesn't actually have to peak at a 95 level, because that would suggest things are getting quite extreme. And if they don't get extreme and we see a much more rather methodic move and then it sort of rolls over, we're not going to see that 95 level being hit. So it's going to require us to be on the ball in terms of what's the market structure doing, what's the global liquidity doing, and what's the sentiment doing. Because if we don't have that large run up where it's so obvious that euphoria is here, the exit signal is going to be a little bit more tricky. But with the correct tools, I think we can get a good average to get out. I would say.
I think this is the perfect example of what we were just saying, because it is one that certainly is elevated, right? Like no one can deny that particular score is elevated. But as you just said, it doesn't, it can go much higher still. It can go to 95, but this cycle could be different and that could be the top that's already in. So this is what makes it confusing for people who are relying on a single indicator. Because if you were just relying on this indicator, well, you'd feel quite anxious about the fact that the top could be in.
if you're relying on this indicator, you've had 3 moments where you've been
Yeah,
extremely
we've been
anxious.
anxious. Yeah.
Yeah.
And
So
well,
yeah.
and that's a point in itself. So you really do need the combination of factors. One of those factors that we've looked at quite a bit is this fear and greed um, aspect. I certainly feel this number is about correct at the moment. It doesn't feel like people are excessively greedy in the moment. At the moment, there's not quite the number of high fives around the office that we often get at these highs. That tends to be my biggest fear and greed one. When everyone's high fiving around the office, that's usually the top.
Yeah, and but just looking at it where it is now, and you were talking about the fair value chart where Bitcoin is. When the fear and greed metric sort of coils in and starts consolidating the mid-range 50 neutral level, well, to me that points where we're at a market fair value region too, just on a sentiment-based viewpoint. So previously we've seen it go red. That's been terrific opportunities to buy, especially when global equity's been ticking up, which I think it was 3 videos back potentially where we had the setup where we were very, very fearful, yet global liquidity was tracking up, and we were all very, very bullish at that point in time. And we've since sprung up to what was it? I think it hit 77 to like 122-ish, which is a significant increase. So right now we're just like you said, we're at that more neutral viewpoint, even though we're at all-time highs, which is objectively the most bullish thing you can have for where we are.
Yeah, that's a really good point, because if everyone was high fiving, that's the problem. That's more of a sign
That's the
that we
problem.
might
Yeah.
not break through. Whereas it looks more, I would be more convinced that we do break through that, because we're not at those extreme levels of sentiment.
Yeah, and it doesn't mean we have to just rock it up in a very fast fashion. We could just have a more grind price action, which is the wall of worry in a way.
And is that reflected in this indicator, the FOMO indicator?
Exactly, and exactly is. You can see here we're not seeing large levels of orange just yet, which you would be expecting at all-time highs, where you'd be expecting a top. So you can see that when we had those major large corrections and consolidated periods, you had significant orange show up, and then you had a 7-month range. Okay, then you had another bracket of orange pop up, and you had like a 4-month range. So you also have seen a glimmer of that orange up the top there, but nothing that has screamed a large amount of fear in the market. So that's quite bullish, and it does to me show that we do have higher prices. It doesn't mean we won't consolidate for a little bit, but I'm quite optimistic for the future.
I do worry about some of these indicators becoming less relevant in a more institutionalized world, but so far they seem to be holding up, particularly the ones that you've selected. I mean, it is going to be something going to need to keep paying attention to. This is interesting when you look at the Google Trends, sort of on that topic, that the Google Trends is very much going to be reflecting retail. You're not going to have a lot of institutional players out there Googling what is Bitcoin. I wouldn't imagine. Like, you would think if they're making those decisions, they're well and truly versed in the topics. But when you look at this chart, it's certainly not at extreme levels at all. I would argue retail's not showing up at all, despite the fact that we're at those all-time highs.
Yeah, and that's actually quite a positive sign, because every cycle peak we've seen everything like Coinbase, the App Store ranking was right at the top in terms of the finance. You've also seen, well, just Google Trends is objectively showing you that the interest is very low, and even from a anecdotal viewpoint, I'm friends and stuff, no one's even talking about it, which is ultimately what you want to see. But they will when it starts reaching insane levels. People will start, well, what's going on over here? As it always happens, right? It's just because we're in a bit of an echo chamber. We're looking at this stuff every single day, so we think it's relevant in everyday lives, which it probably really isn't. But we are starting to see a slight little tick up in there. So what I'm expecting going forward, is we will start to see more interest going towards the end, because that's objective what has happened historically. Even if it might not hit the same levels it always has, but just some resemblance of interest should come in towards the end, I would expect.
Yeah, I do agree with that, because people can't help themselves, and they certainly will get involved at the end. Another metric you've talked about quite a bit, and I know it's one that Joe and I are also very interested in, is these funding rates. We've seen really a sustained period now of decent funding rates, not necessarily the big spikes that have occurred in the past, but it's been consistent for a number of weeks. What is that an indicator of, really, is probably my first question.
Yeah, so
and then the second part of that would be, is that sustainable here? Or is it, do we see that dropping off soon? What's your view on that?
So for those who don't know how this sort of works, so this is funding rates just go over the derivative market and the spot market ratios. It's basically trying to create equilibrium in terms of the price. So when the market gets overextended on the long side, you'll start to see those funding rates shoot up like that to enter a long. So you have to be paying to be in that position, vice versa for the short side there too. So it's more so a telltale of how overextended the market is getting in terms of leverage. And when it typically reaches these large levels in terms of the funding rates, it's often a sign that we're going to enter some sort of reversal. So you can see that even the bear market low, what is it, December 2022, around that region, you had very large negative funding rates. So a lot of participants were in short positions in that sort of situation there. A very one-sided market, and that marked relatively the bottom down there too. And especially in bull markets, what you're really looking for in terms of DC opportunities, those moments of red funding rates. So that can be your point to start to ladder into a position. And it often accompanies with sentiment, as you would expect, because this is a sentiment. It's a sentiment score in itself, and objectively one of the truest ones you can have, because it's literally just going off the facts and the data of the exchanges. So where we are now, like I said, I'm sort of expecting more grinding price action, because we're not at extreme levels at all, and we've seen it stay at these levels for a large extended period amounts of time, and price can just continue to creep up. So we're just going to shoot up and rocket up. There's a chance for it, but I would be more on the side that we're just going to sort of creep, opposed to just insane price action right now.
Yeah, it's a very interesting metric, and I love that point that you make about it's one of the truest measures of sentiment, because you can see it actually in the price action, and it is objective.
Yes, and the market also is. I think I saw, what was it? One of those metrics. What most of the market's actually in derivatives in terms of participants. Like, a lot of the retail, because they're obviously trying to make money fast and all sorts of stuff, and that impacts the way price moves. So, yeah.
This monthly Bitcoin analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell, and swap gold, silver, platinum, and crypto online or in our Brisbane, Melbourne, and now our new Gold Coast showrooms. With over 50 years of operation, we're your reliable partner in wealth management. Visit ainslie.com.au to find out more about Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Joe, you do like to throw up a provocative, little headline from time to time. This was an interesting one. I think for our Australian audience, we have our super system, which is in many cases the envy of governments all around the world, that we have a self-funded retirement system that's so large. The US has their 401k plans. This is quite a significant decision. We've been able to do this sort of stuff here, so we probably take it somewhat for granted that we can have crypto in our super. But the US being able to do that's a big deal.
Yeah, so the reason I've sort of brought along this bunch of slides is to sort of try and pinpoint where we are in terms of the adoption cycle and what it means for returns going forward. So over the next 10 to 12 years. So, I see things like this, and if we were more towards what we believe at the end of the cycle and the business cycle and the liquidity cycle, I would be nearly prepared to say, well, that's about as good as it's going to get, right? So, we spoke about treasury companies last month, and now you've got $9 trillion in 401k plans in the US. So that's obviously a lot of capital that can continue flowing in. I suppose the caveat to all that is that yes, all this good news has come, but the capital can still flow for quite a while and before you get that blow off top, as Isaac was talking about.
Well, and the size of that, I mean, from my perspective, it is a massive deal, because I know how many conversations I have with people who as I said, we've been able to do this for quite a while here in Australia, but people are only now just coming around to, oh yeah, I think I might put a little bit of crypto into my retirement plan. And people starting to go, well, actually, it makes sense to put it in there, because the things you tend to put in your retirement plan are things that you want to hold for the long term. Like it's not a trading activity. It's something you want to buy and hold. Crypto is kind of perfect for that, right?
Yeah. And, we look at sort of what we believe AI is going to do to life expectancy. Like say someone who's in their 30s or 40s can expect to probably live to 100, 110 now. So you actually, if you stop working around 70, then you've got 40 years of retirement. You really want that long duration asset, which is what Bitcoin is providing you. So that's where Bitcoin really sort of steps in as the longest duration asset available. into a portfolio, even if it's only a small sort of percentage in terms of allocation, maybe 5 or 10%, maybe, depending on your risk tolerance and age.
No, it's very
Not
interesting, and I
not
think that
financial
aligns.
advice.
I think that aligns with what you're suggesting here through this graphic, to say, even though for a number of us in the space who are probably many of the people who'll be watching this video who already understand Bitcoin and say, well, it's been around for a long time, it's not that long in the grand scheme of how financial markets develop.
Yeah, absolutely. And I think we sort of get a little bit of a skewed point of view every now and then, because the people we generally surround ourselves are all invested in the same thing. Like, that's our core interest in investing sort of framework. So, but what we've got to realize is that there are a lot of people who don't even know how to get access to Bitcoin for starters, and let alone take that first step to actually getting into Bitcoin. And now, if you flick through to the next slide, we've got we talk a lot about the ETFs, and that's obviously a large driver of adoption and making it easy for that average person to get in. But it's really just the beginning. Like, the ETFs have only been available for 18 months in the US, and the amount of capital just flowing into them is unbelievable. The one thing I will point out is we had that dip down to about 112 last week. We actually had, I think, the 5th largest week in outflows out of the ETFs. So funds or hedge funds or whoever isn't in the long term absolutely puked out a heap of coins. You can sort of only just see it there, but at the top, but it was quite a large outflow. So to me, that's a good contrarian indicator that if ETFs are puking coins, then it's probably a good time to buy.
But also, just looking at that, it's undeniable that we're in an up and to the right trend there. It's being very consistent, and I think anyone who was skeptical about the impact that these ETFs were going to make for Bitcoin, I mean, the proof is right there.
Yeah, absolutely. Like, ridiculous. Like, no one could have ever imagined that it would have been the numbers that we're currently seeing.
When we talk about that, you also highlight just how big some of these specific allocations are and who's making some of these specific allocations. It's still a drop in the bucket, but it's interesting.
Yeah, so this is the 13F form for Harvard. So basically, they got to disclose all their investments. Now, you've got their Bitcoin allocation, which is coincidentally in the BlackRock IBIT ETF, which is now their 5th largest holding out of all their investments. In terms of their entire investment portfolio, it's only 0.22%. So, like, when you're looking at that sort of scale, like, they bought $116 million worth of Bitcoin, and it's only 0.22%. When institutional capital eventually comes around to 2, 3, 4, 5% allocation, which is what's going to happen because it's the best performing asset, and like what sort of that adoption cycle of Bitcoin is just going to continue exploding, which is why I still think we're in that early adopters phase in terms of the entire adoption cycle of Bitcoin.
It's interesting when you say that, because I think it is a self-fulfilling prophecy if it becomes, or if it continues to be, the best performing asset, because we've shown that chart before. 3 out of 4 years, it is the best performing asset. And the 4th year, it's the worst performing asset.
Yep.
But overall, you can't not have, if that makes sense, you have to have exposure, I'm trying to say. If you're an institutional investor, your job's on the line. If everyone else is performing 5% better than you because they've got a few percent of Bitcoin in their portfolio and you don't, it doesn't matter how much you hate the asset, you have to convert, right?
Yeah, absolutely. And I think what is sort of changing a lot of those institutional asset allocations is the volatility starting to be removed from Bitcoin, which we personally aren't a big fan of. But in terms of institutional adoption, they like lower volatility. So, the last 5 years have still seen a compound annual growth return of around 60%, which is still very good. But historically, that's actually quite low. And the implied volatility is quite low to what it has been the previous 10 years. So as that volatility continues to compress, which is no doubt what's going to continue happening, you'll see more and more of this institutional capital flow into Bitcoin. They just don't want to wake up one day and have their allocation down 30%. Effectively, you know what I mean?
No,
that's what they're actually afraid of.
That's the self-fulfilling prophecy aspect of this. This is a provocative chart as well. Do you want to talk us through? Really, it's not great, and we've been having a lot of conversations about this week. it's not great to be a wage earner in this modern world. I think that would be the understatement of the year.
Yeah, and it's obviously where a lot of societal issues come from, because you get the wealth divide between the rich who own the assets and the average working class human who basically lives off wages, which are, like as we pointed out, taxed every year, whereas assets are only taxed at disposal if they even decide to sell them. So this is inflation adjusted. So we'll just pick the S&P because it's the largest stock market in the world. So it's like in real terms, it's actually up 32,000%. But when you adjust it for inflation, it's up 4,500 or 4,000%, right? So this chart's a tiny bit old, a year and a half old, but that's all right. So it's actually a bit higher. But as you can see, in terms of the median income, inflation adjusted, you basically get nowhere, right? Now, inflation adjusted median income is before you pay the tax.
Yeah.
So it's probably actually negative each year in terms of real wage growth. It just highlights the importance of owning assets.
It does highlight the importance of owning assets. And then that led into what was actually the most provocative discussion that we had in a few different forums this week. You went to town with your AI and you put together a table because you were trying to make an argument. I mean, you can explain it better than I can, but I'll give the overview from my perspective.
Yeah, go ahead.
You were trying to make an argument around, look, you'd be better off just leaving high school, not bothering about going to uni, even if you're going to become a doctor, right? Don't bother about university. Don't bother about any of that. Just get an asset that returns 25% or whatever the compounded rate you had. I think it was about 25%. And if you just did that, you're going to be better off. And it just hit such a philosophical nerve with so many people who were involved in this discussion about, well, where do we fit in this world where you've got AI coming along, you've got decisions that people need to make, particularly young people, around careers, if careers are going to be potentially replaced. But then you weren't even going down that path. You were just saying, across all that, if money's your objective, you're still going to be worse off. Just go get a job and buy some Bitcoin.
Yeah. Well, like I'll start off with a couple of assumptions, obviously. So the first assumption is that a high school graduate could make $60,000 we're talking Australian dollars, so this might not be applicable in the US, but someone coming out of high school can make $60,000 a year, which I think is possible if you wanted to grind. You could absolutely do that, and you'd have to allocate 25% of your gross income into Bitcoin at a 25% compound annual growth rate over 12 years, which I think is fair. Like 25%, I think is fairly reasonable based on the 60%.
Well, particularly if you're still living at home. Like, my advice is mooch off your parents for as long as possible. But carry on.
Yeah, well, the statistics are that the average child lives at home until they're 24, which sort of aligns nicely with this because it gives you 6 years as your high school graduate to sort of stuff money away, but it also gives the potential doctor 6 years to live at home while they're studying. So that sort of gave us a bit of an even playing field there. But and I picked doctor because it seems to be the job that would potentially still exist in 12 years with AI taking a lot of other jobs. So. But at the end of the day, you can see the compounding there. If you are able to, as a high school graduate, stick to a plan, have conviction, after 13 years, you end up with $1.2 million, and that's compounding at 25%. Arguably, if you're buying, say last week, for example, when you had a 5% dip, if you put your allocation in then you can compound probably faster than 25%. The point is that the high school grabs the doctor's never going to catch the high school grab.
Yeah, and that was your point. And some people would argue, well, it's not going to continue at 25%, but it might. It certainly, Michael Saylor would argue it does, and we could argue about that. But that's kind of irrelevant because it doesn't really matter what that rate is. It just matters that rate is above normal for an extended period of time. I mean, you only went out 13 years. That seems reasonable to me. Isaac, you're the target of this sort of more of this market, because we've had this conversation multiple times with you deciding over your uni degree. Is it worthwhile? What should you do? Like, it's a conversation that every family's having on some level. What's your view?
It's a conversation that's needed because we're at unprecedented times. We're at that inflection point where things are changing so fast. Now, in terms of what I think about this chart and what Joey said, most likely it's going to play out the way that it's pointed out here, which means on a nominal value, if you want to have more money, then it would make more sense to just go out, get a job, get 2 jobs, do Uber at night, do whatever you need to do to get that money coming in. to invest it. And you will have more over the long run. And especially if you extend that time horizon, you stay diligent to that, that compounding will just keep going and it get more extreme as you go on. Now, but not everyone wants to do that. Not everyone wants to live that life. People do want to have passions, careers, and all these different things. Now, I don't know what the landscape's going to be like in 10 years because the way things are going, it's changing pretty fast. So I can't really exactly say, but what I can definitively say here is you should at least have an idea of what's going on, and you should at least put a bit of your money into an asset at least. Whether it is Bitcoin, whether it's gold or something like that, you need to be allocating some of your money into an asset, as we've seen in those previous charts. Because if you're not, we
Well, you
just saw the
definitely,
CPI chart, all these different charts. If you're not doing that, well, it's to your own detriment. And if you fast forward down the line, you're going to have nothing. There's no
well,
compounding,
and
tax
that bit
eating
is
it all.
undeniable. And I think both sides of the argument would agree. You have to have those assets. I mean, we showed that chart of CPI, inflation, wages versus the assets. You are
Yeah,
definitely going backwards without the asset. I think part of the point for me was that if you don't have, you need to learn how to learn. Like if you don't understand what's going on, then you're really not going to be progressing at all, and you're going to fall further behind in an AI world. So I think education is going to be important. Whether it needs to be a university degree is debatable because there's other ways to learn. I'm not doubting that, but how, do you need that structured environment? I think Joe.
you do.
Well, I think Joe, from your perspective, from my perspective, because we've shared a lot of this journey, we've had to force ourselves pretty much into structured learning to be able to, not through university, but through structured learning to be able to understand all of this stuff around global liquidity and the things we know now, which is ultimately the source of our wealth.
Yeah, absolutely agree. It's like I said, at the end of the day, if you're going to follow, if a high school graduate was going to follow a plan like this, it does take a level of conviction, which means you'd have to actually spend the time doing it and believe that in a 13-year plan, and then you also have to have the discipline to actually execute the plan.
And Isaac, I'll give you the final word on this particular one before
Yeah.
we move forward. Like, what would your advice be to other people sort of probably in a similar situation to yourself that are either at university or thinking about going to university against the backdrop of this table, against the backdrop of this discussion?
My advice would be you better look into it now, because the longer you leave it, the harder it's going to get. And especially as the volatility does go down, which inevitably it most likely will in Bitcoin specifically. Well, there's less compounding for you there, and also AI is getting better. So your intellectual ability in terms of what you can offer to the workplace is going to greatly diminish. Because what can you do that's going to beat some 4,000 IQ AI? There's nothing you can really do. So we're entering a world where it's going to be very different, and you better start looking at this as a young person. But most people, when they're young, they're not thinking. They're thinking, "Let me have some fun. Let me explore myself." That sort of stuff. If you do that, especially now, I think you're going to look down the line and think, "Oh, I regret doing that." But obviously, you got to have fun in your life. But you know what I'm saying.
Yeah,
I think like from a philosophical point of view as well, is that people in their 18s and their 20s believe that they have to have the fun in the 18s or 20s. Whereas I think, people who have made their money in their 30s or mid 30s or early 40s, for example, you can still go out there and have fun.
100%.
Except you've actually got the capital to back yourself
Yeah.
and enjoy the fun for the rest of your life. It's like each to their own, but like that's the reality of it.
And I would say objectively, once you're more mature and you're in your 30s, having the money, having the backing is better, opposed to struggling in those years where your body has less vitality as you age. So it's better to be financially set up.
Okay, we're moving off this topic. It's getting very personal.
We're
Getting
turning
very
into
aggressive.
Andrew
I
Huberman
think that was all
podcast here
directed
now.
at you, Joe, by the way, not me. I think that was
Yeah.
Okay, well, we'll move on from Isaac calling us old to talk about, with Isaac telling us about some technical analysis. You've looked at the macro cycles. Obviously, that was what Joe was talking about at the start, but you sort of look at it slightly differently through this lens, particularly around timing aspects of when you expected the end of the cycle to be. Last time I remember you telling us that the potential was there for us to move beyond the green, but we're certainly in the potential area for a top. Is that still the case?
Yeah, like we said, especially tracking with global liquidity, that with that expectation that we actually might be topping out in Q1 of 2026, we'll have to see obviously how it pans out. But where we are right now, it is suggesting that we're entering later stage of the cycle in terms of the traditional Bitcoin cycles. Because we do typically top out around this point of time. Now, what it might be showing to me is because people are going to be looking at this, and if we have the background information that we actually might be topping in a little bit later, we might see towards the end of it a decent sized correction then for the final sort of flush up, which is what I'm sort of now seeing, because in terms of what I might what I expect, because I would expect a lot of participants to be starting to take chips off the table around that point in time, and then if we start to creep up, that might create some sort of FOMO in the market at that point in time.
Yeah, and I'd actually expect that as a more logical outcome, because it can't just be what everyone thinks. It's got to catch people off guard. That's what markets do. If it's a predictable always 4 years, then everyone is on the same page. So what you just described would make more sense to me, I think.
Yeah, and it's not even been a predictable 4 year cycle. Just look at the last one. It peaked out objectively, you would say it peaked out that first peak down. The last bit was a bit of a weird peak, but it did land within that timing band. But it wasn't even worth the risk of holding it that long when you think about it, for a, I don't know, $2,000 increase of what the previous top was.
You didn't get rewarded for that extra hold.
Exactly.
But it was very confusing at that particular time. If you break that down to the weekly cycles here, like this, it still is within the ballpark of what we would expect, though, for timing. Yeah.
Yeah, so like right now, what I'm seeing, like you said, we might grind up to around that 130 region towards maybe a month from now. See what happens with that. But what we would suggest is we might actually have that correction, right? And we're seeing that stochastics are looking quite similar towards the first sort of band, where you're seeing that bit of a divergence there too. And we might, especially with the timing of these weekly cycles, I did an average there, which is around 217 days if you aggregate them all together. That would suggest that we should bottom towards that end, and a good pivot to then start that last run up if we do have that same formation. So people might be taking chips off the table towards the end of this weekly cycle, and then for that final. And but what I'm trying to get here is that people might think that's the end of the whole entire bull run, and then the sentiment starts to drag out, and that's it, it's over. You'll see this tweets on Twitter and all that sort of stuff, and then price starts to slowly creep up again. Then that final sort of situation. We'll have to see. We're going to take it month by month, but as a hypothetical situation, it might have some sort of resemblance to that.
It does make sense to me, hypothetically at least. And you've been talking about these for a while as well, the volume areas that are of particular interest. It seems, well, obviously, when we get to new all-time highs, there's no history there because it's new all-time highs by definition, but it has been respecting those levels throughout this move.
Yeah, and as it really should, because they're just volume regions where a lot of transactions have taken place in the market. So you're going to see reactions from those levels. In terms of what I'm looking at here now, where we are, we really don't want to be closing below that market structure level, because that has been a consistent support and resistance line. In terms of can we go and tap into it and wick in there? Yeah, 100%. But we don't want to start to have consistent closes beneath that, because that would start to show that we're having acceptance back into that previous range, and you could say it's a fake out of that range. So we don't want to be seeing that ideally if we want to hit that 130 region. And the global liquidity is pointing towards that higher sort of grind up, which I would be expecting. Now, I'm not going to be alarmed if we do dip back down for a short-term time frame, but yeah, on a weekly basis, we really don't want to be closing beneath those levels.
I think on that chart, that previous chart, sorry, it really shows the importance of those volume nodes. It takes quite a powerful, aggressive move to get out of each one. Like once you're in
100%.
them, you really have to explode out. And if you're looking at currently where we are now, well, we have had a bit of a pullback since we hit 122 yesterday, but I can see how potentially we may retest that and then just keep heading on our merry way.
Yeah, and also the gaps there, they're actually called, when you have levels where there's not much volume, they're called single prints because the volume's quite low. It's more so an order flow thing that people look at in the more extreme terms of trading. But when those single prints, price tends to shoot up, and you can see that there. We shoot up from volume region to the next one. So yeah, that's why with all-time highs, you can start to see it rocket up quite an aggressive way. But yeah, there's a little side tangent there.
The market structure here, it's still, again, consistent timing wise with what we've seen historically. There's nothing out of the ordinary yet, but it's certainly not the first half of that move.
Yeah, and what it is showing though is if we're going to be following this sort of times, we are coming towards the end of this specific weekly cycle. Like, not saying we can't go up. I know personally I'm expecting it to go up, but we're in the latter end of that stage of this specific cycle here too. And the reason it also looks like it's not that increased much nominally is because I'm on a logarithmic chart. If you took it off there, you'd see we actually had very large appreciation in terms of where we are now.
Yeah, and it is important to look at things in log scale, I think, often. Um, just looking at it a bit more zoomed in, you've got that major pivot point highlighted there. I mean, it's certainly in the middle of nowhere at the moment, but my bias is that this is the what we've seen this morning. I mean, it depends when people are watching this, but where we've seen the price dip back down a little bit, I think that's probably a fake out before it breaks out to the upside. Is that your view? Looking at it a little
Yeah,
bit more
like I
locally.
said, I'm just sort of looking at it from market structure viewpoint. I just don't want to see it consistently close below that major pivot there point because that's a strong support and resistance level for where we are. Another thing is the volume weighted average. I put that on in the last video we did as a level to be looking at, and it hit it quite perfectly and bounced off because it also coincided with the previous market cycle, kind of previous local pop there. So when you accompany these metrics, a lot of local traders are looking at that, and you start to see bounces because the more you zoom in, that's where those traders are going to be, and price tends to operate when there's confluence in a region.
I love this metric. It's worked really well for us when we've been looking at the price action recently. It perfectly called the move lower, and it perfectly called the move higher, really, both in both directions. Joe, you and I were both looking at this a fair bit recently. It cleared out. There was you can't see it sort of now because it's been cleared out, but it cleared out a whole lot of price areas of interest above and cleared them out below. Now it's looking like we're building up a lot of leverage positions above. Isaac, is that consistent with what you would expect for that next move higher? Because you said you were sort of expecting it higher. I think Joe and I are as well. Is the picture we're seeing on the screen here
Yeah,
consistent with that?
yeah, you want to see a lot of build up coming in, especially from the short side, because that's sort of what enables that grind up, especially if you just consistently, as price is going down, you're seeing shorts build. It when price does eventually revert and go back up, it just eats away at it and causes like a depending how many shorts there are, can do a bit of a short squeeze, basically, is what I'm trying to say. And then as you hit all-time highs, then people start to long that as you go there. But what you want to be seeing is a lot of shorts enter, and then price continue to go up.
Joe, I know you've been looking at that quite closely as well. The, is it behaving how you would have expected around all-time highs?
Yeah, so I'll touch on something like a technical indicator that we actually mentioned last night. I think it was with so we obviously had a large move over the weekend, over Saturday and Sunday to the upside, and and Isaac would probably be able to touch on this better, but it created what's called a CME gap, and generally though it's just a gap in price on the CME where no volume was actually traded. So we saw that price push up to 122 yesterday, and there was a large CME gap around that 118,000, which is coincidentally where we touched this morning. So I think now that that's sort of those price levels have been traded, we would probably move towards those liquidity zones up around 122 and then potentially past that again. What do you reckon, Isaac?
Yeah, and those CME gaps, I mean, like as we've got, there was an episode we went over and talked about in depth, but they're really just a psychological thing. There's actually basically no real reason for them to hit it, but when everyone's looking at it,
Yeah,
it sort of becomes a self-fulfilling prophecy in a way.
yeah. I think 95% of the time it hits them. So
Yeah.
it's
And it is.
from
I completely agree. Um, the logic isn't necessarily there beyond the fact that everyone's looking at the same level. So that's where
yeah,
price tends to gravitate towards, just because everyone's on the same page.
100%.
Look, well, that brings us to the end of the sort of charts and our usual analysis. We like to wrap up with a little bit of a summary. I'll start with you on that one this time, Isaac. Sort of wrapping up where you see us right now as we're here on the eve of potentially new all time highs, and where you see us over the probably month ahead.
Yeah, so I'm expecting price to grind up a bit further. If we potentially might be hitting the 130 region, 135. We'll have to see how it pans out. But nonetheless, I do expect higher in terms of price, and then a more decent sized consolidative or drawdown. We'll have to see how it goes month by month, but we'll update that as we go through. But from what I'm looking at in terms of where we're on the weekly cycles and all those different metrics, I would expect it to sort of start to peter out for a bit as people start to take chips off the table towards that going into then It would make it a perfect storm for a Q1 top, in my opinion, if we were to do that.
Interesting. Joe?
I think from our liquidity and macro framework, we're still reasonably early enough in the cycle to expect that this is not we're not currently anywhere near the end of it. Over the coming months, as I spoke about, we've got a large refill to TGA, which will be quite positive liquidity once that starts being drained. And also agree that we're probably likely to see higher new all-time highs in the coming weeks. Like historically, August, September are not very good for price action, but this market also has a way of throwing people off and doing the exact opposite of what they think. So, yeah, still quite constructive.
It does have a way of throwing people off, but I think from my perspective, pulling together everything both of you have been talking about, it's a very interesting time when we don't have we certainly have elevated indicators, but we don't have anything giving us a sign that the top is in. And from the global liquidity perspective, it's green lights, I think, still for quite a bit yet. So my perspective on it is that we're probably going to take out those highs, and I really like that liquidity metric we showed that did have a price target of around sort of the upper 130s to just a bit under 140 over the next few months. That seems reasonable to me as a potential target. What I am expecting that we didn't really touch on too deeply beyond Isaac's sort of indicators is that when we hit one of those levels, I think we will get a big pullback. I think that this has been pretty easy as far as legs of bull runs go, where it's just been up and to the right for an extended period of time, and people maybe are a little bit too complacent that we're never going to get a 30% correction or more again. I think we are going to get one. Just kind of to your point, Joe, still part of this cycle that we're in. It's not the cycle over, but I think we're going to get a scary pullback that's going to remind people just how Bitcoin can behave when it chooses to. Look, thank you both so much for what you always do, bringing all that information, bringing those slides together. Really appreciate that. Love that conversation this month on Joe's, going off on his own little tangent there about should you be a doctor or should you be a Bitcoin maxi? It's an interesting conversation, but thank you both for your time. Thanks, Joe. Thanks, Isaac.
No worries.
Thanks, mate. We need more Bitcoin maxis, less doctors.
Need more Bitcoin maxi, less doctors. Well, you're
society.
I'm joking.
You're getting very old, Joe. Just ask Isaac. So you probably need more of those doctors than you think. But anyway, look, thank you everyone for watching. We'll be back again for what will it be, September, to dig back into this, see where we were right, see where we were wrong. Thanks for watching, and we'll chat again soon.